Sarah was 34, 3 years into a 30-year mortgage, paying 7.5% interest on her home in Ohio. Every month, $1,850 left her account, and it felt like she was barely making a dent. Then a coworker mentioned two words: mortgage refinance. Sarah had heard the term, but had no idea if it applied to her situation. 6 months later, her monthly payment dropped by over $400. So what did she do right? And more importantly, how do you know if refinancing makes sense for you? That's exactly what we're breaking down today.
So let's start with the basics. Refinancing your mortgage means replacing your existing home loan with a brand new one, ideally at a lower interest rate or better terms. Think of it like trading in an old car for a more fuel-efficient model. You still owe money, but now the deal is better. When Sarah first looked into it, she thought it was complicated and expensive. And here's the thing, it can be if you're not careful. Refinancing typically costs between 2 and 5% of the loan amount in closing costs. That's a real upfront expense you have to factor in. But when the numbers line up, it can save you tens of thousands of dollars over time.
Here's where Sarah's story gets interesting. A popular rule of thumb in personal finance is called the 1% rule. If you can lower your mortgage rate by at least 1 percentage point, refinancing is worth exploring. Sarah was at 7.5%. When she checked current rates and found she could qualify for around 6.3%, that's more than a full point drop, her ears perked up. Now, this rule is a starting point, not a guarantee. Your actual savings depend on your remaining loan balance, your credit score, how much equity you have in your home, and the closing costs your lender charges. But for Sarah, the math was looking very promising, and this was the moment she decided to dig deeper.
Let's look at the bigger picture. This chart shows 30-year fixed mortgage rates over the past several years, pulled from Federal Reserve data. You can see rates hit historic lows around 2021, below 3%, then surged to near 8% by late 2023. As of 2025, they've started to ease somewhat. This context matters because refinancing only makes sense if today's rate is meaningfully lower than yours. If you locked in a rate in 2020 or 2021, refinancing right now probably doesn't help you. But if you bought during the 2023 rate spike, like Sarah did, you may be in the perfect window as rates gradually decline. This is why timing is everything.
This is the concept that changed everything for Sarah, the break-even point. Here's how it works. Refinancing comes with closing costs, in Sarah's case, about $5,200. But her new rate was saving her $412 every single month. So you divide the costs by the savings. $5,200 divided by 412 equals roughly 13 months. That means after 13 months, she's officially saving money. Every dollar after that is pure savings. The key question you have to ask yourself is this: how long do you plan to stay in this home? If you're planning to move in the next year or two, refinancing might actually cost you money. But Sarah was planning to stay long-term, and that made all the difference.
Let's put a real number on this. When Sarah ran her numbers, factoring in the $5,200 in closing costs and her new monthly savings of $412, over 10 years, she stands to save nearly $50,000. That's $49,440 in her pocket instead of her lenders. And that's not counting the fact that those savings, if invested, could grow even further over time. This is why doing the math matters. It's not about whether rates dropped slightly, it's about whether the total picture adds up for your specific situation. For Sarah, it absolutely did. This is the power of one informed financial decision.
Here's a side-by-side look at how Sarah's mortgage payment changed. On the left, you see her original loan, a $280,000 balance at 7.5%, giving her a principal and interest payment of around $1,850 per month. On the right, after refinancing to 6.3% on her remaining balance, that payment dropped to about $1,438. That difference, $412 a month, is real money. Money she can now redirect toward an emergency fund, retirement contributions, or paying down her loan faster. This chart makes it visual. Refinancing, when timed correctly and executed smartly, is one of the most impactful financial moves a homeowner can make.
Now let's talk about the flip side, because refinancing isn't always the right call. Sarah's situation worked out beautifully, But there are clear scenarios where it doesn't make sense. First, if you're planning to sell your home before you hit that break-even point, you'll likely lose money on closing costs. Second, if your credit score has dropped since you first got your mortgage, you may not qualify for a meaningfully better rate. Third, here's one most people overlook. If you're 20 years into a 30-year mortgage and you refinance into a new 30-year loan, you're essentially restarting the clock. You could end up paying more interest overall, even if the monthly payment feels lower. Always look at the full picture.
There's another type of refinancing Sarah considered, the cash-out refinance. This is where you refinance for more than you currently owe and pocket the difference as cash. Say Sarah's home is now worth $340,000 and she owes $270,000. She has $70,000 in equity. A cash-out refinance could let her access some of that, maybe $40,000, while still refinancing to a lower rate. Sounds great, right? But be careful. You're increasing your total debt and extending your loan. This can make sense for high-return uses, like consolidating high-interest debt or funding a home improvement that adds value. But using it for vacations or everyday expenses, that's a trap that can cost you your home equity over time. Proceed with caution and purpose.
So if you're in a situation like Sarah's and you're ready to explore refinancing, here's exactly what to do first. Step 1. Check your credit score. Most lenders offer the best rates to borrowers with scores of 740 or higher. If yours is lower, spend a few months paying down debt and correcting any errors on your credit report. Step 2. Calculate your personal break-even point using the formula we covered. Step 3. Shop around. Get rate quotes from at least 3 different lenders, including your current bank, credit unions, and online lenders. Rates can vary significantly. And Step 4. Don't just look at the monthly payment. Ask for the total interest you'll pay over the life of the loan. That's the number that really tells the story.
Today, Sarah's monthly payment is $412 lower, and she's using that extra money to max out her Roth IRA every year. She didn't need a finance degree to make this decision. She just needed to ask the right questions and run the numbers. Here's what to remember. Refinancing can be one of the most powerful moves a homeowner makes, but only when the timing is right, the math works, and you have a clear plan. Use the 1% rule as your gut check. Calculate your break-even point. Shop multiple lenders, and always think long-term. This is educational content meant to help you understand your options. For advice specific to your situation, please consider speaking with a licensed mortgage advisor or financial planner.
Everything in this video is for educational purposes only and does not constitute financial advice. Mortgage rates, savings projections, and scenarios shown are illustrative and based on general assumptions. Your results will vary based on your personal financial situation. Please consult a licensed financial advisor or mortgage professional before making any refinance.